Hello everybody, this is Toni Turner and welcome to the market now as of about 11 a.m. Eastern on Friday, February 3rd. Before we start, please join us at the Money Show in Orlando, Florida, February 8th through 11th. I will present a session on February 10th called Buy Low, Sell High, Power Up Your Profits with Active Investing. For more information, please go to worldmoneyshow.com. And now on to the market. The monthly jobs numbers came out this morning and told us that U.S. job growth surged more than expected in January as construction firms and retailers ramped up hiring. Non-farm payrolls increased by 227,000 jobs last month, the largest gain in 4 months. But the unemployment rate rose 0.1 of a percentage point to 4.8%, and wages rose only by 3 cents, suggesting that there is still some slack in the labor market. Still, the labor market continues to tighten, which could soon spur a faster pace of wage growth. Federal officials view the labor market as being at or near full employment. And now let's go on to 3 charts that could give us some insight into the week to come. First of all, as we usually do, we're going to look at a daily chart of our S&P 500 SPDR, symbol SPY. As you all know, this is the exchange-traded fund that closely follows our S&P 500 index. Well, we've been in wait-and-see mode here for quite some time, and it looks like nothing much has changed, although the market is very positive today. The SPY made a new all-time high at last week at $229.79. A new closing high last Wednesday, I should have said, at $229.57. Now, as I captured this chart today, the SPY was trading at $229.43. So as you can see, it's just within kissing distance of that all-time closing high. It'll be interesting to see where it closes today. Now, as we're talking about this, the SPY, of course, at near its all-time highs, is trading back above its 20-day moving average, the red line, certainly above the 50-day moving average, the green line, and also way above the 200-day moving average, the black line. So we can see up here that we can call it $230 for near-term resistance. Then we have support down here at about 228. We have more at about 225, and right now that's where the 50-day moving average is coming in. Then, of course, we can look down here to about $222, where this pivot came in on the last trading day of 2016. So we have a lot going on here. And next week is going to be exciting because we want to see, this is where the rubber meets the road here. Can the SPY, can the S&P 500 take off here and continue this mighty uptrend that it's been in? If you look at a longer term chart, you can see it. Or is it in the next week going to have to give back some gains? So again, we're kind of in wait and see mode here. The RSI, the 14-day RSI on this middle scale where you see me pointing to, it's essentially going sideways just above the 50 line, the midline. So that's positive, and again, it's essentially moving sideways here horizontally. The MACD, the moving average convergence divergence oscillator, say that fast 3 times, is also moving horizontally above its 0 line, the midline, and so that is also positive. I guess we just want the SPY or the S&P 500 to do something, and I suspect that next week will give us that information. Either we're still in earnings season, of course, we've got some headline risk coming in here, but we always do. So question is, does the S&P 500, is it going to get the fuel from earnings season and everything else to move up here, break out over these all-time highs and continue its uptrend, or is it going to have to take a rest, pull back a little bit? And actually that would be a good thing because it would give us some better opportunities to enter trades here. So let's wait and see. Keep an eye on the SPY next week for sure. Now let's go on to our next chart. And again today we're going to look at the iShares Russell 2000 ETF, symbol IWM. This is the exchange-traded fund that tracks the Russell 2000 Small Cap Index. Now, if you've seen the market now before, you know that many times when the going gets a little dicey or a little questionable with the S&P 500, I will keep track more closely of the iShares Russell 2000 ETF because these are mainly U.S.-centric stocks. And the IWM has been, or the Russell 2000 Index, has been known to be kind of a leading indicator for the broader markets. So if it can't get off get out of its consolidation zone here, if it cannot get out of that and move higher, then I'll be kind of looking at the SPY with just a little more caution. Now, when I captured this chart today, the Russell 2000, the ETF, the IWM, was trading at $106.58. It made an all-time high back here on December 9th of $138.82. And ever since then, it has been slowly trading in a consolidation range that is edging downward. Now, we could call it a flag, but flags typically they're only flags. This is more of a flag right here, right here. They only last 2 weeks is the longest we give them. This is, of course, a couple of months long. So the IWM here is definitely holding up. Today it's trading above its 20-day moving average. The 50-day moving average now has come up to meet the 20-day moving average. The 20-day is now going horizontally. The 50-day is up to meet it. So this is really where the rubber hits the road here. The IWM has to show us if, again, it has the strength next week, if good numbers can propel it higher and continue this uptrend it's in, or is it getting kind of worn out? We could say it looks like it's kind of got a lightweight hangover here. Does it need to break down below here? The line in the sand we're looking at is $133. That's our support line. Can it stay above this $133, or will it need to break below it? What we don't want to see is it breaking below 130 because that could pressure the broader market down. So if the IWM perhaps can propel its way upward, go back up to, say, 139, move higher, be great. If it has to take a rest, we're watching 133 and 130 as our potential support lines. Our final chart today is a chart we haven't looked at in quite a while, Select Sector SPDR Consumer Staples ETF. As you all probably know, staples have been more or less selling off since last summer. You can see the XLP here, Select Sector Consumer Staples ETF, has pretty much sold off. Now, top components in this particular exchange-traded fund are, these are big dudes, Procter & Gamble, Coca-Cola, Philip Morris, Walmart, CVS. And again, they have sold off pretty darn dramatically. The XLP made a high in July, or a near-term high of $56. That was in 2016, obviously. And since then, it is headed south. You'll see it is definitely headed south down to a low here of $49.98. So right at $50. It bounced up from that at the end of last year and has been kind of moving sideways to up since then. Again, staples took a heck of a beating. Now, when I captured this chart today, the XLP was trading at $53.08. So it's come up off this $50 mark. It moved up off of it in December, has traded sideways, had a few days below the 50-day moving average in January, but then popped back up over the 50-day moving average. What I'm really looking at here that I like is the price pattern. We have here a pretty quick double bottom, if you can see the way I've drawn this. Then it came up, whenever you see a bottom reversal pattern, you usually see a handle, I'm going to call it, that takes place after that. And this handle has come down, moved sideways as it's supposed to, come down, as I said, below the 50-day for a few days, and then pop back higher, making a higher low above the 20-day moving average. And now it looks like it could go higher. It's now bumping into the 200-day moving average. But I'm thinking here, if the XLP can get above the 200-day moving average, then it could have further upside to come, especially if interest rates are kept low. Now, again, this 53.08 zone, as a trader, I probably would prefer to wait and maybe look for a pullback here back to, say, 52.50 or 50, even 52. As long as the XLP stays above, however, the green line here, the 50-day moving average, I'm going to look at it in a positive way, especially if it can pop above this 200-day moving average. Say it closes on the first of the week over $53. Then I'm definitely going to look at it as a potential long-term, hopefully long-term vehicle on the long side. And we'll be seeing if it can potentially move back up toward 54, 55, maybe even 56 in the longer term. But keep an eye on consumer staples here. And again, as long as it's above the 50-day moving average, I'm okay. If and when it falls below that, I am definitely out of the trade. Okay, now let's go on to next week economic reports. But first, by the looks of my charts and the headline risk I see coming, this month's market may become a giant roller coaster. And that's really good news because volatility, meaning wide price swings, always hands us big opportunities. Now, some traders are going to know how to take advantage of those opportunities, but many of you won't. And those who don't know how to take advantage of them are going to leave some money on the table. So the question is, are you ready to take more gains out of the market this month? Now, if you are, I can help. This week only, we are discounting our online recorded webinar, 3 Winning Setups, by 20%. Now, in this training, I'll show you 3 setups I use for my trades and how to execute them and manage risk so you minimize your losses and maximize your gains. These are the setups I use for my own personal trades. So don't delay. This sale will end soon. For more information, go to the link on this page, ToniTurner.com, and click on the pop-up ad that you will see on our homepage. 3 winning setups. And now on to this week's economic reports. Please know that we're still in the middle of earnings season and results from high momentum large caps are going to continue to move the market. The economic reports this week are very few. On Wednesday, we have crude inventories. Thursday, we have jobless claims and natural gas inventories. Friday, we have the Michigan Sentiment Report. Again, don't forget to check out 3 winning setups. I think you'll enjoy it, and I think it will help you make more money. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.